Hello everyone and thank you for joining our course. Today we are going to talk about simple but important terminology from the stock market, such as long position, short selling, take profit order, stop limit order, bull market, bear market, stock, bond, option, technical analysis, fundamental analysis. Okay, let's start with defining what is a long position. A long position, also known as simply long, is the buying of a stock, commodity, or currency with the expectation that it will rise in value. Holding a long position is a bullish view. A long position is the opposite of a short position. A short position is created when a trader sells a security first with the intention of repurchasing it or covering it later at a lower price. A trader may decide to short security when she believes that the price of that security is likely to decrease in the near future. There are two types of short positions: naked and covered. A naked short is when a trader sells a security without having possession of it. However, that practice is illegal in the US for equities. The covered short is when a trader borrows the shares from a stock loan department. In return, the trader pays a borrow rate. Now, after we know what is a long position and a short position, we can talk about take profit order, stop limit order. Short positions can be created at any time. A take profit order (TP) is a type of limit order that specifies the exact price at which to close out an open position for a profit. A stop limit order is a conditional trade over a set time frame that combines the features of a stop with those of a limit order and is used to mitigate risk. It is related to other order types, including limit orders, an order to either buy or sell a specified number of shares at a given price or better, and stop on quote orders, an order to either buy or sell a security after its price has surpassed a specified point. Now, after we learned all of that stuff, now we can talk about what is a bull market and a bear market. A bull market is the condition of a financial market in which prices are rising or are expected to rise. The term bull market is most often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estate, currencies, and commodities. Because prices of securities rise and fall essentially continuously during trading, the term bull market is typically reserved for extended periods, in which a large portion of security prices are rising. Bull markets tend to last for months or even years. A bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent highs, amid widespread pessimism and negative investor sentiment. Bear markets are often associated with declines in an overall market or index like the S&P 500, but individual securities or commodities can also be considered to be in a bear market if they experience a decline of 20% or more over a sustained period of time, typically 2 months or more. Bear markets also may accompany general economic downturns, also known as equity recession, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a proportion of the corporation's assets and profits, equal to how much stock they own. Units of stock are called shares. But what is a bond? A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer. Bond details include the end date when the principal of the loan is due to be paid to the bond owner, and usually includes the terms for variable or fixed interest payments made by the borrower. And what is an option? Options are financial instruments that are derivatives based on the value of underlying securities, such as stocks. An options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they choose not to. Call options allow the holder to buy the asset at a stated price within a specific time frame. Put options allow the holder to sell the asset at a stated price within a specific time frame. Each option contract will have a specific expiration date by which the holder must exercise their option. The stated price on an option is known as the strike price. Options are typically bought and sold through online or retail brokers. After we know all of that, you are probably asking yourself, but how do we trade them? And the answer is simple. You use technical analysis and fundamental analysis, so let's define them first. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Fundamental analysis, FA, is a method of measuring a security's intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and industry conditions, to microeconomic factors like the effectiveness of the company's management. In the next video, we will talk about more things you need to know, and then we will start teaching you our secret technical analysis method.